Do you know how much money you have, how much money you need, and how much money you want? Do you know how to make, save, invest, spend, and borrow money wisely? Do you know how businesses and governments manage their money and financial goals? If you answered no to any of these questions, or if you are curious to learn more, then you must watch this video titled as Finance for Dummies. Finance is a broad and complex subject, but it is also very relevant and useful for everyone, regardless of your background or profession. Finance is the science and art of managing money and financial goals. It helps you understand how money works, how to use it effectively, and how to create value and wealth. Finance covers many topics and areas such as personal finance, corporate finance, and public finance. Let's start with personal finance. Personal finance is the management of your money and financial goals. It involves planning, saving, investing, spending, and borrowing money in a way that suits your needs and preferences. Personal finance is important because it affects your financial well-being and security. By managing your personal finances well, you can achieve your short-term and long-term goals, such as buying a house, paying for education, retiring comfortably, or traveling the world. You can also avoid or reduce financial stress, debt, and risk, and have more control and freedom over your money. There are many aspects of personal finance, but here I have discussed some of the most important ones. Budgeting, that means the process of tracking your income and expenses, and allocating your money to different categories, such as necessities, savings, and entertainment. Saving means the process of setting aside a portion of your income for future use, such as emergencies, opportunities, or goals. Investing is the process of putting your money into assets, such as stocks, bonds, or real estate that can generate income or increase in value over time. Spending is the process of using your money to buy goods and services that you need or want, such as food, clothing, or entertainment. Borrowing is the process of obtaining money from a lender, such as a bank, a friend, or a credit card company, that you have to repay with interest. Some of the key concepts and terms that you should know in personal finance are: net worth, that is the difference between your assets and liabilities, or what you own and what you owe. It measures your overall financial position and wealth. Cash flow means difference between your income and expenses, or what you earn and what you spend. It measures your ability to meet your financial obligations and goals. Interest means the cost of borrowing money, or the reward for lending money. It is usually expressed as a percentage of the principal amount per year. Compound interest is the interest that is calculated not only on the initial principal amount, but also on the accumulated interest. It makes your money grow faster over time. Inflation means the general increase in the prices of goods and services over time. It reduces the purchasing power of your money. Next, let's talk about corporate finance. Corporate finance is the management of a company's money and financial goals. It involves making decisions and taking actions that affect the value and profitability of the company. Corporate finance is important because it helps the company create value and maximize profits for its shareholders, who are the owners of the company. By managing its corporate finances well, the company can invest in profitable projects, optimize its capital structure, and manage its working capital efficiently. There are three main areas of corporate finance, which are: capital budgeting, the process of deciding which projects to invest in, based on their expected costs and benefits. Projects can be either long-term or short-term, and can include expanding production, launching new products, acquiring other companies, or developing new technologies. Capital structure, the mix of debt and equity used to finance the projects. Debt is the money borrowed from lenders, such as banks, bonds, or loans, that has to be repaid with interest. Equity is the money raised from shareholders, such as stocks, dividends, or retained earnings, that does not have to be repaid, but gives the shareholders a claim on the company's assets and profits. Working capital management, the management of short-term assets and liabilities, such as cash, inventory, accounts receivable, accounts payable, and short-term debt. Working capital is the difference between current assets and current liabilities, and it measures the company's liquidity or its ability to meet its short-term obligations and operate smooth. Some of the key concepts and terms that you should know in corporate finance are: Net present is value the difference between the present value of the cash inflows and the present value of the cash outflows of a project. It measures the profitability and value of a project. A positive NPV means that the project is worth more than its cost, and a negative NPV means that the project is worth less than its cost. Weighted average cost is the average cost of the different sources of capital used by the company, weighted by their proportions in the capital structure. It measures the minimum return that the company has to earn on its investments to satisfy its shareholders and lenders. Finally, let's discuss public finance. Public finance is the management of the government's money and financial goals. It involves collecting and spending money for the public interest, such as providing public goods and services, redistributing income, and stabilizing the economy. Public finance is important because it affects the welfare and development of the society and the country. By managing its public finances well, the government can provide adequate and efficient public goods and services, such as roads, schools, and hospitals, reduce inequality and poverty, and maintain economic growth and stability. There are four main components of public finance, which are public revenue, the sources of income for the government, such as taxes, fees, and grants. Taxes are the compulsory payments made by individuals and businesses to the government based on their income, wealth, consumption, or transactions. Fees are the voluntary payments made by individuals and businesses to the government in exchange for specific goods and services, such as licenses, permits, or tolls. Grants are the transfers of money from one government to another, or from an international organization to a government, for specific purposes, such as development, humanitarian, or military aid. Public expenditure, the spending of the government, such as education, health, and defense. Education is the spending on schools, colleges, universities, and other educational institutions and programs to improve the human capital and skills of the population. Health is the spending on hospitals, clinics, doctors, nurses, and other healthcare facilities and services to improve the physical and mental well-being of the population. Defense is the spending on the military, police, and other security forces and equipment to protect the country and its citizens from external and internal threats. Public debt, the borrowing of the government, such as bonds, loans, and deficits. Bonds are the securities issued by the government that promise to pay a fixed amount of interest and principal to the buyers at a specified date in the future. Loans are the agreements between the government and a lender, such as a bank, another government, or an international organization, that specify the amount, interest rate, and repayment schedule of the borrowed money. Deficits are the excess of public expenditure over public revenue in a given period of time, usually a year. Public budget, the plan of the government's revenue and expenditure, such as surplus, balanced, or deficit budget. Surplus is the excess of public revenue over public expenditure in a given period of time, usually a year. Balanced is the equality of public revenue and public expenditure in a given period of time, usually a year. Deficit is the excess of public expenditure over public revenue in a given period of time, usually a year. Some of the key concepts and terms that you should know in public finance are taxation, the process of imposing and collecting taxes from individuals and businesses to generate public revenue and influence economic behavior. Taxes can be either direct or indirect, progressive or regressive, proportional or proportional, and can have different effects on efficiency and equity. Fiscal policy, the use of public revenue and expenditure to influence the level of economic activity, such as output, employment, and inflation. Monetary policy, the use of the central bank's control over the money supply and the interest rate to influence the level of economic activity, such as output, employment, and inflation. This brings us to the end of this video. I hope you learned something new and useful about finance. Finance is a broad and complex subject, but it is also very relevant and useful for everyone, regardless of your background or profession. Whether you want to manage your personal finances, start or grow a business, or understand how the government works, finance can help you achieve your goals and make better decisions. Subscribe to my channel if you enjoyed this video and want to see more content like this.